Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is Digesting IPOs from A to Z. So my name is Shane Chu. I'm the moderator for this session. Now, the hottest investment topic in the recent years is always the IPO because they got a lot of retail investors who got into IPOs and make some winning profits because most of the strategies here may not really have a very high success rate, but IPO strategy in the recent years has produced very huge winning rate. So today we're going to talk about what is initial public offerings and how you can fill this IPO from the subscription to performing your first trade in the newly listed IPO. So today we're going to talk about IPOs, how do you read prospectus, and what are strategies to go about doing IPO. Now, before we begin, as usual, disclaimer, whatever we share in this session is only for educational purpose. In no way that I give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decision, you're solely responsible for all your investment risk. Now, allow me to briefly introduce our speaker today. So he first indulged himself in the SME financing industry right after finishing his diploma in finance and investment from Ta University College. He continues to pursue his interest in the finance and capital market by joining Rakuten Trade and TS Securities, which he held the position of risk and compliance officer and dealer's representative. To date, he has over 7 years of experience in the capital market as an investor himself, where he also runs One to Invest, a financial blog which amassed over 60,000 followers to date. He's also the associate director for private equity firm Sansuria Capital Sdn Bhd. Currently, he is a SGX Academy speaker. So he's none other than Mr. Max Tan. So Max, how are you today? Good to see you.
Hi Shane, good evening everyone. Hope you guys are doing fine. I'm doing fine.
All right, fantastic. So we can't wait to learn from you what are the strategies that we can go about doing IPO. So over to you.
All right, thank you so much for the kind introduction. And once again, good evening everyone. Hope you guys had your dinner already. So today we are going to talk about IPO from A to Z, from their filing to first trade and understanding your subscription. What are the risks and what are the things that you should look in the IPO, right? And a quick disclaimer first, as Shane has mentioned just now, and I have to do a disclaimer that no information presented today should be any form of investment advice. And because I'm not a licensed person to do so, if you need, you can look for contact someone that is licensed, maybe a licensed analyst or your dealer rep, okay, or your reminder. And we might or might not mention some company names later on as case study, but bear in mind that this is solely for the purpose of using what we have learned today and reapplying into real life case studies, right? It is not a recommendation whether this IPO is good or this IPO is bad. Okay. And okay. So let's jump into the basics of an IPO. And for the benefits of everyone, I think there could be a mix of someone that is you are in the market for some time, and there are some that are fresh to the market. So for the interest of time and also for the interest of everyone, I will briefly go through what basically is an IPO, right? Very quickly. Okay, so what exactly is an IPO? You always heard from Shane, he mentioned just now, recently IPO performance are very good, right? So that a lot of people, they are interested in looking into IPO, but what exactly is an IPO, right? So you heard it so many times, so you always look at the trading screen and you see, wow, 50% gain, 100% gain, and maybe sometimes it's down. And what actually is an IPO? So the former term of it is the first sale of shares to public, right? I also want to create some awareness here. If you see any sale of securities from some sketchy platform, meaning that, oh, this is a pre-IPO opportunity for you to invest. This company haven't got listed yet. It's a Sdn Bhd, but if they're offering shares to you, offering shares to the public is actually against the law, right? So be very careful. And even though it's a per heart level, when they're offering their shares to you, it's not listed. Per heart is not equivalent to listed. So be careful on that. And basically, IPO is their first ever offer of shares to the public to be traded on a particular securities platform. Like in Malaysia, we only have one, which is Bursa Malaysia, and in US we have the Nasdaq, and we have the New York Stock Exchange, and in China we have the A50, and Japan, of course, we got the Japan Stock Exchange, right? So basically, it's very simple. So, for example, if you have a company, you're going for the public and you're allowing more people to participate in the shareholding of your company. So this is the first ever sale of shares to the public, right? And but why people want to go for IPO? You see, nowadays a lot of people they say, "Oh, my company, I want to go for IPO." So what's the purpose of it? Apart from glamour, right? I'm a listed company owner. The true objective of all IPO, most of the time, is for raising capital. Raising capital, that means that by issuing more shares to the public, the company is able to raise money into the company, right? Issuing new shares. So I want to make a distinct difference here first, right? So in social media or in news, you always see that, oh, there's issue of new share. There's also offer for sale. What does this two mean? When a company is raising capital or they're issuing new shares, it's basically like the company is selling you shares. So the money will go to the company. But if it's an offer for sale, that means that the shareholder, original shareholder of that company, they're selling their shares to you. So no money will go into that company. It will go to the selling shareholders. So that's the difference between raising capital in the sense of company raising capital or the ex-shareholder, I mean not ex-shareholder, but the shareholders of the company, major shareholder, they are selling the shares to you. But the ultimate objective is going public is for the liquidity and also for raising capital, right? And from private to public. So you can imagine that if you run a small business, let's say you sell nasi lemak, right? Selling nasi lemak as a business, you're very successful, but yet if you want to raise fund, it's quite difficult, right? You go to the bank, you always have a capping of your gearing. So the alternative is that you go to somewhere else, which is the equity market, to raise fund, which is through IPO. And once they're listed, you have a lot of other ways of raising capital, like issuing private placement, right issue, RCN, RCPS, etc., etc. But that's not the topic for today. Basically, sets your status from private to public for the interest of number one. We mentioned just now glamour. People know more about your brand. Let's say ABC Nasi Lemak. Last time, not a lot of people know about you. Now, people that are in the capital market, they say, hey, ABC Nasi Lemak is actually listed. Number two, when you go and talk to your supplier, right? Let's say basmati rice supplier, right? You talk to them, hey, I'm a listed company. Can you give me a longer term when you supply the rice? I will give you back the money in 60 days because I need to manage my cash flow, right? If you're non-listed, you're a private company, probably your supplier or your customers, they're more careful in terms of giving out terms. But when you're a public company, it's likely that you have a better negotiation power when it comes to doing business, right? And also the publicity of it as well. Okay. And also the liquidity for shareholders. Nowadays, if you look into Malaysia and KL20 this year, we talk about a VC golden path. Basically, Malaysia, we want to cultivate more venture capitalists, private equity to make the market more vibrant, right? You know, when a business from private to public is a very long process. It's not like, oh, my business, I'm starting to grow, then I want to go IPO. No. Even though the ACE market, we do not have a return profit requirement so far. But if you look at all the companies that go for listing, they actually hit a certain number, which is 4 to 5 million and above. So imagine that if you are somewhere around 1 to 2 million, right, and you want to go IPO. So there's a gap between 1 to 2 to 4 to 5. And in this period, you might look for alternative funder like private equity or venture capitalists. They might come in at that time, fund you, and ultimately their objective is to make profit from it, which the liquidity is needed. Okay. So Shane has mentioned just now, so far the IPO performance in Malaysia is quite good. Not me saying, but statistically so far so good lah. Okay, if you look over here, I'm not sure if you guys can see. Actually, this is from Bursa website. If you guys interested, you can look out for or look out on it from Bursa website. If you look at it, most of the A's market, you look at their listing date, and this is the listing price over here. I wonder if you guys can see my mouse. This is the listing price over this column, and this is the first day closing price. So most of it, for this period of time, 52 weeks, actually the IPO performances are mostly higher, right? First day closing. But there are a few that underperform. You can see over here, here, some of them they perform afterwards, right? But a lot of people here, probably you're here today because, oh, I want to know which IPO I want to subscribe to. I want to know how I can study on this IPO so that I can sell it on the first day, right? We'll talk about that later on. So this is just statistically speaking, and I believe this is to a certain date. If I remember correctly, this is to last week. Okay. The IPO price, first day closing price versus the current price. Okay, up to that date. If I remember correctly, I'm taking this data 1 week before. So the data has already changed here. If you want, you can look on Bursa website. Regardless, there's a trend also can serve as somewhat need you guys to be a bit more careful on this, is that if you look over here, actually quite a number of the company after IPO, their share price actually tanked, especially after the first day hike, they actually tanked. So how do you avoid this? It depends on how much you understand on the company itself, right? If you couldn't get the IPO, probably you're interested to what we call is chasing it after the first day. But what are the risks associated when you're chasing it on the first day, right? It depends on how much you understand the company. It also depends on the company itself. It also depends on the valuation of the company, right? So yeah, here you can see most of them are performing quite well. Okay, let me zoom it back. Actually, this slide as well. These are the recent IPO to the surprise of many. I know last time when I was doing a webinar with one of the brokers, a lot of people are saying 99 Speed Mart is very expensive. So their first day performance is okay, not bad. But now already performance is very strong. Okay. Of course, these are something to do more technical in terms of fund flow, but we'll talk about the fundamental of the company more in this webinar, right? That's our focus today. Okay, and the number one myth of IPO, I think already debunked in the last slide, which IPO, I heard a lot of people saying that IPO guarantee win, right? There's two spectrum to this. Number one, guarantee win. It makes that, oh, new IPO come up, I just go and subscribe. As you can see over here, right? Actually, there are a few cases that actually drop in the first day. So you are banking on selling on the first day without studying anything. I don't think that you can have a very good win rate, especially when you go for IPO. Normally, the success rate of getting an IPO based on normal guy like me, our capital, maybe we put in 10,000-20,000 into one IPO subscription, right? And you can imagine the success rate is somewhere around 3 to 5%. So 3 to 5%, imagine the 3 to 5% you get one IPO that is dropping on the first day, right? Because you didn't go through it. So yeah, the number one myth is not all IPO can perform, especially after IPO, especially you're holding it or you're chasing it after the IPO process, right? So again, nothing is guarantee win. Someone tell you guarantee win, please run away. And a lot of people, there are actually a lot of scam cases back in this year and also last year that people are impersonating broker houses and also issuer houses. They're saying that, oh, I have this IPO, I have this ping form for you to invest in, right? But you have to deposit to me, you have to use my name because I'm the one that gets the private placement. Most of the time, you have to be careful because this could very much be scam unless there's no unless. When you're putting money like that for things too good to be true, most likely it's a scam, right? No guarantee win at all. Right. And most importantly, how do we evaluate an IPO? What are the things that we need to see? What are the things that we need to check out? Okay. there are a couple of elements which the number one, which I always emphasize, is the business model of that company. Right. Business model is very important because whatever financial data you are seeing is already a lagged data. This one, if you joined my webinar before, I talk about this many, many times. Quarterly report delayed by 2 months, annual report delayed by 4 months. So without understanding the business model of that company, it's very hard for you to predict or to analyze or to get a sense how the company can perform financially in the future. For example, right now, okay, let's not try to be, it's not an investment advice, but if you look into, this has something already passed. If you look into the foreign investment into Malaysia, very simple. Ringgit has been performing very strong. At the time we are talking now, it's 4.1 something, right? Last time was 4.7 on the highest. So what would happen to the company with the business model of exporting with US dollar base, right? It's very simple. Their profit is likely to drop, and their profit is likely to drop. But for the companies that are doing import business from maybe countries like China, right? And with the ringgit strengthening, do you think their buying power will be stronger at this point of time? Would it benefit them? So by understanding the business model of the company, the nature, even though very simple as only import or export, you already can get a sense of how the company can perform later onwards. Then you dive deeper. This company is in construction, right? How does the construction market in Malaysia performing so far? If it's someone related to, Johor is booming, a lot of things going on, the Singapore and also Forest City, the special economic zone is going to be something very interesting. And also all this construction or M&E, mechanical, electrical related to that data center. So you see their performance has been very strong previously. That's from understanding their business model, right? What they are doing. And also there's one hidden thing that I think that everyone should know about business model is that there's a scarcity premium to everything. Okay, so imagine if I'm doing something very niche, like in Malaysia, we got a chip designer, right? So it's a scarcity premium. If you want to buy chip designer, you think chip design business is good in Malaysia, there's only one company for you to buy, right? So there's a scarcity premium to it. And if you want to buy a property company in Malaysia, if my math is correct, we have more, I think easily more than 50 companies that are involved in property development, right? So with this many property developments company in Malaysia, which one to choose? So there's no scarcity premium. That's why there are certain sector, their stock is priced at a lower valuation. One of the reason is such. Because if I don't buy your company at 15 times, I can always buy the next one at 14 or maybe 13, right? So understanding a business model, try to look, is there any scarcity premium? If there's a scarcity premium over there, probably is something that could add on into the valuation of that company afterwards. This is on the business model part, right? Understanding a business model is really, really, really important. Okay. And back to the basics, regardless of the IPO you're looking at, income statement is still super important, right? Income statement is basically the revenue, the company, the profit, how much profit they're making, what's the margin compared to the peers. Are they making better margins? And are their revenue growing so far? Most of the time, if you look at the prospectus of the company, historically, their performance is very good most of the time. But after IPO, I'll talk about this, how to be careful on this, right? After IPO, I've seen a lot of cases where, number one, a lot of people, they might get panicked because they report a loss, but oftentimes that is because of their IPO expenses. But if you take out the IPO expenses, they're still making loss. That means that there's something not right, right? I will dive into that part a bit deeper later on the income statement. Then it's to the balance sheet. Balance sheet is basically the healthiness of a company, I would say. So how much asset do you have? How much liability do you have? Do you have a lot of asset? Are you utilizing them nicely? Or are you over gear? You have a lot of debts on you. So balance sheet is very important in this sense. And also, we mentioned just now, to raise fund, raising capital, right? In most of the IPO, in Malaysia, you can see that they have an IPO proceeds utilization. What does that mean? It means that you can get a sense of what they are going to do with the money raised from the IPO process. For example, if the company is aiming for growth, most of the time I'm not finger pointing any company. If a company is aiming for growth, a lot of time you will see that they are using it for expansion plan, right? For expansion plan. For example, they are buying new factory, buying new machinery, or investing in new technology, or expanding headcount, or expanding into a different region. These are expansion plans, right? That the company, they are seeing growth. That's why they need capital and also to go public at once to raise fund and they to continue growing the business, right? If a major chunk of it. But if you see an IPO, right, that are using the money to go for working capital, what does working capital mean? Working capital basically means that, oh, I'm buying inventory is to pay off my payroll. Yeah, most of the time is to buy inventory, payroll, trade receivable, trade payables, whatnot. It's basically for my working capital, as the name suggests, right? And also for debt payment. So for these two parts, you can see that it's basically the company is not using the money raised from IPO to grow further. Unless, again, back to point number one, it's a business model that they do not need further expansion. They need money to buy more raw material. Then it's a different story. It depends on how well you study the prospectus or how do you understand the business model, right? So look into the IPO proceeds utilization. A lot of time, if they are using the money to pay off debt, to me, is not something too good, right? You are going public, yes. Your gearing is lower, yes. But you're paying off debt. There is not enough excitement, at least for me, right? You are only paying off debt. What's your growth plan afterwards? But it can get a bit tricky. It can get a bit tricky. You have to look. They are paying off debt for what? There are, I think, 3 or 4 prospectus that I have read throughout 2023 or 2024. They, on paper, is paying off debt, but is to pay off debt that they have spent on acquiring a factory. Now, trick question, is this expansion or is this paying off debt? To me, it's expansion because they are still doing something to continuously expand their business, right? But to pay off debt is like, oh, I have 100 million, not maybe not so much, 10 million in debt. I just pay off the debt in order to lower the interest expenses I have, without mentioning that, oh, this is actually for whatnot. This is actually last time for working capital. Now I got more capital to deploy. Yeah, so look into the IPO proceeds utilization. And this is one of the part that a lot of people probably you didn't. I mean, for a lot of people, we do not have time, right? I mean, prospectus. I don't know if you guys can see over here, right? Is this thick? So I don't know if you guys have the time to go through the whole thing, but if you do have the time, go through the IMA report. One of the things that I believe is that knowledge can be stacked, right? After you understand an industry, the next company you're going to study is going to be super easy, right? So look into IMA report. It explains the whole value chain of that company that is involved in, which I will talk about IMA report. IMA is actually, IMA report. I will talk about IMA report a bit deeper later on, but IMA report is very, very important. And also, this part is understanding the fundamentals of an IPO, the risk. We will talk about it. How do we assess the risk later on, right? So let's go to the first point. The business model. Okay, so you might ask me, so they're so thick, this prospectus. Dynamic Spin one is even thicker, I think it's compared like this. It's so thick, the prospectus. So where do we start? To save your time, I can roughly tell you which part you should look for in the prospectus. Normally it's section 3, section 4, section 7, section 8, and section 12. Probably section 9 as well. Okay. It depends on which investment, which principal or which sponsor it is. It could change. But the things that we mentioned just now, business model, income statement, balance sheet, IMA report, IPO proceed utilization is usually in 3, 4, 6, 7, 8, 9, and 12. normally. For example, 9S Mart, if you want to understand their business model, just flip to section 7. They will tell you from their start, how do they start their business, what did they do. Like over here, they actually mentioned that they have 2006 outlets. And I think in the deeper part of that writing of section 7, I think they also mentioned that regionally, southern region, Sabah Sarawak, northern region, central region, how many outlets they have and serving to how many clients, right? This is one of the example of understanding the business model. So after understanding a business model, what should you do? You should try to look into the macro economy. Is this beneficial for this business model? So let's say, if you are looking into one construction company, but you know the price for cement and also for steel bar is skyrocket now. It's not actually, as a matter of fact, construction material prices stabilize. This is just a scenario. And okay, back to the scenario, labor shortage. So do you think they can perform well going forward, right? At least in the short term, they might face some trouble. So you can imagine their financial performance post-listing, is it going to be good? Probably not, right? Unless they can do some magic or they can do something special, then they can outperform their peers. So understanding a business model here, right? Like back to 9S Mart, why are they so special? Basically, they are the largest mini market outlet in Malaysia. If you look at their market share growth for the past 4 years, it's crazy how much market share that they have captured. And I believe within 1 or 2 kilometers of your house, you probably will see an 9S Mart. But anyway, I'm not a shareholder. I'm also not planning to buy. It's just talking about how impressive their business model is on 9S Mart, right? So yeah, understanding their business model and then try to link it back. We mentioned about IPO proceed utilization, right? After you understand the business model, you can see or you can analyze on their IPO proceeds utilization. Does it make sense for me that I don't want to name any company, but let's say if I was doing this selling nasi lemak last time, now I'm telling you I like mee xuan, so I'm going to do soft drink business with the IPO money. Is it an expansion plan? Yes, it is. But do I have the prior experience to do soft drink? No, I'm doing nasi lemak last time. Would it work? Probably yes, probably no. But the risk is higher as compared to expanding what they're already doing or just adding another new product. Probably they are not doing it completely new themselves. But they probably work with someone to, oh, if you buy nasi lemak, I will get, you can also buy soft drink from me, right? Cross-selling opportunities. So understanding the business model here is very important. Okay, so section 7, I will go into one of the company that is just launched their prospectus, I think last week. If you have the time, we go as a case study, we'll go through the prospectus briefly together, right? And financial overview, this is on section 3. On the first, I think 20-30 pages of a prospectus, you can check it out. Roughly, you can see what are their financial performance trend. Is it growing or is it declining? Is their margin improving or their margin is declining? Then you try to figure out whether the margin is sustainable. Let me give you an example. There are cases in Malaysia or Bursa that one company, they used to have, let's say, single digit PE. Suddenly, before IPO, their digit spiked to double digit, so that their revenue maybe not increased by a lot, but in terms of PAT, profit after tax, it increased by a lot. Do you feel that, wow, this company is doing so well that the margin increased drastically, right? So what have they done right that they deserve such a good margin? Trying to find out, that one is on section 12, the financial reporting. But if you look at the surface, you already see that the company revenue or profit trend is already dropping or already stagnant. Probably is not too good of a sign. Why? Because when business owner know that they're going for IPO, usually they would try their best to have better business, whether it's giving better terms to their clients or having some promotion or whatnot. Because something very realistically is that most of the IPO, they are priced based on PE. price to earnings valuation. So imagine the higher their profit, the higher the market cap. It's that simple. And the higher the market cap, and back to the earlier part, sorry, right? Yeah, back to this part, raising capital. The higher the market cap, the lower the dilution you need for raising capital, the higher the valuation. Always remember this, right? The higher the valuation, the lower dilution to the existing shareholder in terms of raising capital. So any rational person or rational company, or any shareholder, rationally speaking, they would want the minimal dilution possible, right? So if it's still showing you a stagnant kind of trend, it's probably not something too good, right? Something you should look into, really. Okay, this is the financial overview. So for the benefit for those who are fresh into capital market, what are the things that you need to see? It's very simple. Revenue, which is what we call top line, is basically the sales of the company. What's the total sales? And the profit before tax and profit after tax of the company. Some company, a lot of technology company, they might have tax exemption, right? They have tax exemption, then their PAT margin is relatively higher, and also closer to PBT. But tax exemption, for your future reference, if you come across any IT company or any technology company or software company in the future, if they have a tax exemption which increase their PAT margin, which in turn increase their PAT, that tax exemption is usually 5 years and another exemption for another 5 years. Yes, I think MD, we call MD status for the tax exemption. Last time is, I forgot what's the term already, but now it's MD status. So trying to find out when is the exemption. I give you a scenario. Malaysia, our statutory tax rate is 24%. From zero tax percentage to, let's say, okay, effective tax rate maybe 20%. So you're registering a 80% PAT as compared to the last year. I repeat this, very simple. So last year, let's say your company earning 50 million, right? 50 million. Your effective tax rate is 0 because you have a tax exemption, right? Fast forward to this year, my tax exemption expired. Now I'm giving a 20% effective tax rate and I'm earning the same level of profit. But even if I'm earning at the same level of profit, because after tax, my profit still dropped by 20%. You get what I mean, right? Because of the tax rate. So when you see a PAT margin and PBT margin when it's very close, do look into it whether they have any specific tax exemption. Would it expire? If expire, when? Right? And it's very important to look into the profit margin of a company. A lot of companies, it depends on by sector to sector. Construction, single digit. And retail-based business like 99, even though their numbers is extremely huge, it's likely to be single-digit PAT margin. Technology company like semiconductor is very common to see anywhere between 20 to 30. If they are doing a bit of trading, maybe in the range of 15, 20, right? And if there are some companies that are very, very niche, for example, in Malaysia, we used to have a company with 50 over plus PAT margin consistently, that is genuinely doing business based on what I know, right? So look into the PAT margin and you can link it back to business model, link it back to their peer comparison, whether this business, this profit after tax margin makes sense or doesn't make sense. Okay. Balance sheet. Now, balance sheet is the bit, if you're not someone that likes to crunch number, then probably balance sheet is a bit boring for you. But it's still very important to look into the balance sheet to understand that whether this company, are they highly leveraged or are they healthy with cash flow? This is the same. If you want to look into the in-depth year-on-year comparison, it's still in the section 12 of a prospectus. Okay, you need to flip to further back of a prospectus. You need to look into it. Now, to me, it's only for my own preference. I do not stand for anyone's investment methodologies, but for my own preference, the lower the gearing, the better it is. The higher the gearing, the higher risk the company has in terms of defaulting. So let me give you an example. Just imagine like a normal person, right? So imagine if I'm working, I'm earning a salary of 5,000, right? And I have one car and one condo, right? So I owe the bank a certain amount of money. But touch wood, I got retrenched. I lose my job. So I lose that source of income and I owe the bank. Do you think my risk of going bankrupt is high? Yes, definitely, because bank doesn't care. To be frank, bank doesn't care whether you are working or don't working. They still ask you to pay on time, right? Compared to a person that is also earning 5,000, but is using a very old, let's say, my first car ever, Proton Saga, right? I bought it with cash, very cheap. I think it was 3-4 thousand, and I do not have that. I'm only renting. So, in the event if I really see economic turn, I lose my job. At least I don't have the burden to I have a car loan and condo loan on me, right? Bring it back to the business. If you're looking into the business, if it's performing well now but it's highly geared, then you try to look into their balance sheet. Is it over gear? In where it could be a risk when the market downturn is there, their income is lesser, they might not able to repay the loan, right? And also to look into the balance sheet, be very careful on something called trade receivable or other receivable, generally speaking. Trade receivable and other receivable is something that cannot run, right? Even though the business is growing rapidly, but if their trade receivable and other receivable is constantly ballooning, right, and their cash flow is not healthy, then something is not right. If a company, let's say, I think for those who experience past 3-4 years kind of capital market, you know that when a company they are performing very well, right, their profit hundreds of million in terms of profit, but they still need to go through private placement or right issue to raise fund, then we know that something is not right. If you're doing so well, why the need to dilute the shareholding of the shareholders now to raise additional capital, right? If it's only once in maybe 2-3 years, okay, I think that's okay. Business, we need money sometimes for expansion. But every year, for Bursa, they have a mandate to get 10% placement issuance without shareholder approval every year. So it's in your, when you go AGM, right? So 10% issue 10% every year, and plus they might request for additional 10-20% from shareholder, then something is probably not right in the balance sheet. Be a bit careful with that, right? It's not applicable on all cases, but most of the time it's a red flag sign for you to look into their balance sheet. Same goes for IPO. If a company they are building up their profit previously on the basis of increased trade receivable and they're taking out a lot of loan, so you really need to be a bit careful on that, right? But of course, if they're net cash, I'm very happy. Okay, and utilization of the IPO proceeds. This is the example again for 99 because everyone know 99, right? So over here, this is an example that most of the fund, although they got a lot, I think I think correct me if I'm wrong, 1.7 B was offered for sale, and then 600 something was the issuance of new share, which means the money is going back into the company, right? 600 something million for the expansion of the company and paying bank borrowing. Ignore the company name, ignore the total sum raised, but this is the ratio that I would be more comfortable with, that I can see that you are really expanding. Although expanding, there's a risk. Doing business, there's definitely a risk, but at least that I know you have a growth plan in mind, and if possible, go through why they are expanding into this. Is it because their order book increase? Is it after study the business model, you know that they are scalable? You know that there's strong demand. Let's say next year, finger crossed, semiconductor sector will come back. You know that they need to prepare for that expansion, right? So you need to look into the utilization of their IPO proceeds to see whether it makes sense or not, right? Okay, IMR report, something that not a lot of people could be interested in reading, but it's still very, very important when you go through a prospectus of a company and studying the IPO. Because like the IMA report over here, it practically tells you who are the these are the types of competitor that they have over here, right? On the bottom part, you can see, oh, mini market 99 is comparable, more applicable to EconSafe, Bila Mart, Giant Mini, etc. etc. So it's a bit different from Village Grocer, Mydin, Lotus, Aeon B, EconSafe, for example, right? At least you know who to look for as their competitor. And then try to, if you are hardworking, you can try to look at their peers. Are they performing previously, right? And how are their peers performing? If you know that their peers is performing well, so you at least you know the industry is still vibrant. Okay, it's not a sunset industry. But if you know that their peers is not performing, then there's a chance that this is a sunset industry. And of course, you need to be a bit careful when you're buying into an IPO that's in sunset industry. But of course, I believe the regulators, they will do their job. Sunset industry, of course, they also know. I believe they know better than us, and they will be more careful on it as well. Right. So after going through all these parts, don't worry, we'll go through our actual prospectus later on, page to page, right? We need to go into the risks associated in investing in IPO. Okay, so a lot of risks are involved in IPO. If you notice that I have talked about balance sheet, financial, business model, utilization of proceeds, and even IMA report, but I'm not mentioning something yet. Is the valuation of that company, right? Valuation of a company is very subjective, and if you are not careful when you're reading the prospectus, sometimes you could get the wrong valuation. Why? Because it's a practice. It's not something good or something bad, right? But it's a practice. Sometimes they have two different valuation. One is lower, one is higher. The lower one is usually pre-diluted. We mentioned that company is raising capital through issuance of new share. So usually it's based on last year's financial, right? Last year, how much they're earning per share, EPS, and calculate with the share price. So we got a PE valuation. But in terms of share price or the market cap, in terms of market cap, it consists of two things. Number one is the share price. Number two is number of shares. The higher the number of shares, the higher the number of shares, the lower the EPS, earnings per share, the higher the PE, right? And applicable to all market, not only IPO and also in secondary market that we trade day to day. The higher the valuation, the higher the expectation there is for this company, and the higher the risk. Very simple. So that's one very important risk. And if you look into the prospectus, normally they would tell you line by line what are the risks associated with this company. Let me give you an example. Foreign exposure risks. How many percent their revenue is exposed in a particular currency, right? How many percent of their purchase are denominated in a particular currency, right? So with ringgit so strong, you really have to be careful with the upcoming IPO that are export orientated, especially in US dollar, right? They might still perform, but it might not be so good in a sense. But import wise, probably will be better. And a lot of times they are also risks dependent on particular major client. Running a business, a lot of times you might depend on a couple of major clients, right? So in a better way, in a nicer way to put it is that, I built such a good relationship with them. We work with them, we are partnered with them. But it's still a risk to me in that sense that if you lose or if you jeopardize the relationship with this client, it will significantly impact your financials, right? So this is one of the key risks. The rest of it are succession planning, and also the older prospectus will tell you about COVID-19, but now I think with COVID, it's long gone. and I'm not talking about COVID risk associated. Probably they will also talk about dependent on supplier, and also they will talk about the expansion plan may or may not materialize, which I think is quite fair. So these are the risks that you should look into in the prospectus: single client risk, currency risk, and also the valuation risk, right? Because now, from the years I've been actively looking around in the market, right? People are still commenting, wow, 30 cent is a very cheap IPO. Wow, 1 ringgit 50 is a very expensive IPO. But please look into the valuation. The 30 cent could be 30 times in PE valuation, but the 1 ringgit 50 could be 15 times in PE valuation. It has a lot of factors that blend in. Not only the share price is important, it's the valuation of the company and the prospect of the company that is important when you're looking into an IPO, right? Okay, so we have we have a bit of time left, so allow me to share screen on okay, one moment, guys, on the prospectus. Okay, if you have any questions in the meantime, please feel free to type in the comment box. We'll come back on it later on. Okay, so this company is a company that just launched their prospectus not too long ago. Press Group is a quite interesting, you could call it a tech, it is a tech company, right? A lot of people compare them with QES. It's something very, I don't know how to put it, but something very interesting to discuss with if you're into technology companies, right? As we mentioned just now, so if you do not have the time, so just screen through all this and jump straight into section 3 onwards. It'll be quicker, right? Okay, section 3, we will start with, normally public ballot portion, it's always 5%, with 2.5% to Bumiputra and 2.5% to the public portion most of the time. So this is on the balloting part. And this is the ultimate dilution. What is the dilution percentage? So that means that after this IPO, 27.1% of the shares of this company will be held by outsider. According to Bursa requirement, most of the time they require 25% and above, except for companies like Mr. DIY and Nanai Speedmart, which due to their market cap size, they are very huge. So they have a particular exemption. Why does this matter? It actually matters. So imagine that if the dilution is up to 40%, the owners only hold 60%. What kind of message are they telling you as compared to a company with 27% dilution, right? What kind of message are they sending you in that sense? Try to think from that perspective. And the lower, the lower the dilution outside, so, supply and demand. Try to think of it when more supply and demand is floating in the market, what will happen, right? And this is section 3. Most of the time, section 3 is an overview of that IPO stuff. It tells you what does the company to do. For example, like Press Group, they do imaging, analytical, and test solutions. Basically, they are equipment supplier. They don't manufacture, but they will understand the demand of the client, and then they will do consultation, customization, installation, commissioning, and also after that, there is an after sales service. So from here, reading this, what we can understand is, number one, we know that the business model is not manufacturing. So they are buying from a third party and to sell it to another person. So do they have an IP right? No. Then next, you need to ask, what kind of agreement or what kind of relationship do they have with their supplier? Do they have a vast range of supplier that customers say, I need the solution to ABC and they can supply? For Crest, based on what I observed, probably yes. And also, we can know that there is two spectrum of revenue generation over here. Number one-off sale of equipment, which is the provision of imaging, analytical, and test solution. That one is one-off, right? So it very dependent on the market condition, whether their clients are expanding or not. If their clients slow down, it will also slow down in terms of buying new equipment. It's quite, it's quite common sense on this. But provision of after sales service, the more machine that they deliver, the stronger their revenue stream could be in the future, right? Over here, so we get a rough gauge of how the company runs or their business model over here. And you can see that, oh, who do they serve? Semiconductor, E&E, automotive, life science, and I think there was, research and academic institutions, right? Universities, colleges, and whatnot, right? And you can see they serve Malaysia, China, Thailand, and also Singapore. So trying to figure out what kind of currency they are doing currently, right? And this is their strength. What they would mention is usually they will mention, oh, our management has a very good experience in this field, and you see relationship with their supplier, and and also expansion plans. Like I mentioned just now, you need to see what kind of plans they have and whether it makes sense or not. For press, I want you guys to figure it out whether it makes sense or not, right? They are moving number one HQ to centralize in central region, and I think it's also a showroom for them to showcase the equipment to their clients, and also they are expanding further into Malaysia, China, and also Thailand, and also Vietnam as well, right? So Vietnam, a lot of people might not look into it, but actually the semiconductor sector in Vietnam is doing quite well, especially on VSIP, Vietnam, forget the name, Vietnam Singapore Industrial Park, VSIP. They are doing quite well. So I think for them to set up in, if I remember correctly, Ho Chi Minh. Ho Chi Minh is 17 kilometers away from VSIP, right, which is the industrial park. So I think it's quite interesting. I don't know whether they will be involved in VSIP or not, but at least I know that, oh, Vietnam, they are doing quite okay, right? And also risk factor here. Some of the risk factor could be in the further part of prospectus, or some of it can be on section 3 as well, right? They will mention what are the risks, sometimes in section 4 also, right? So dependent on their customer and also supplier, and equipment principals, which are the supplier, and key senior management. This is basically on the succession planning, fluctuation of foreign exchange risk, and also insurance compensation, right? What happens if there's a fire, touch wood, or whatnot. Okay, this part used to be super long in prospectus for 1 or 2 years ago, but now pandemic is way behind us, and hopefully it's behind us forever. So this part is shortened quite significantly. Okay. And this is the shareholding structure part. Not, I mean, okay lah, you can look into it. And here, utilization of the proceeds. So they dive a bit deeper into what they are going to do with each of their sum. I think in section 4 of the prospectus. Right, this is the financials of the company. Try to look into it and see their profit margin. Is it expanding? Is it decreasing? And their profit, is it increasing or is it decreasing? Is it in line with what the general industry is doing? Okay. But again, this is a very, I would say, a very brief overview over here. And if you want to look into the deeper part, it's in, sorry, I think it's in section 12. This is already the audited report version, which is a photocopy version. Anyway, you can still see on, let's say, 78. Yeah, this is section 8. Yeah, so this is section 12, right? Sorry, section 12, historical financial performance. So they will dive into much deeper details, like if you look over here, they do not mention the balance sheet. Some company mention, some company does not mention. It depends. But anyway, you can still find on section 12, you can see how much cash they're holding over the years, and also inventory level, and most importantly, the thing I mentioned just now, be careful on trade receivable, whether it's ballooning over the years, and the gearing level, the debt level of this company. So far, if I remember correctly, press is quite low gear over here. Yeah, they're not they don't have debt at all, right? It's quite a clean company. And current ratio, it depends on it mentioned the liquidity of the company, 2.4. Conventionally and generally speaking, is quite okay, right? And this is their operational highlight. a bit more technical because they will tell you segment by segment what are their products. So I remember in their prospectus, they also mentioned that their products, more general products below 300,000, slightly more advanced, 300 to 500,000, and very advanced, 500,000 and above, right? So you can study into that and try to see whether each of the segment, what kind of growth they will experience. And over here is something that we all like. Dividend policy, they are paying out 30% because they are not very highly geared. So 30% is quite, I would say, achievable in this sense. Okay. So this is section 4, timetable. And yeah, I think timetable is more important. They usually have the risk over here. It depends on principle, principle to principle. So let's jump to section 7. Okay. Sorry. Okay, section 7. This is the part where they would mention the history and background of that company, right? Right, a bit lengthy lah, because this is the shareholding changes. Some they founded the company, or some they bought over the company and grow it to a higher level, right? So I think for Crest, this is the case, one of the case. And this is their key milestone. You can see over here how they expanded over the years. Normally, if they have a certain years of experience, it's relatively safer, I would say, because they are not completely fresh to the market. They're already in the market for a certain number of years. Okay. And yeah, this is diving deeper into their fundamentals. They have the 300,000, 300 to 500, and also advanced equipment. And so this is the detailed breakdown of what kind of equipment to what kind of equipment. If you don't understand, don't worry, because this is a bit technical already. You only need to understand that what kind of industry they are serving, and is that industry growing overall, right? Which is the industry over here, and also the foreign exchange. How would that impact them? That will also be in the section 12 as well. Okay. And this is diving deeper into the business model because it was quite, they only mentioned briefly just now, and they will dive into deeper here, right? For example, like they are serving the back-end semiconductor. A major chunk of their revenue is coming from the semiconductor industry. So in semiconductor, I always say is that it's not, I always say, but factually, there are always two parts of it, back-end and front-end. Front-end is something to do with wafer prior to packaging. Prior to packaging is before they become a chip, with something covering the chip. For example, ceramic, or for example, let's say, yeah, usually ceramic, something that protects the chip itself. So in this part over here, they're talking more towards with over here start. Then we are talking about the back end semiconductor in Malaysia. Again, when you talk about back end semiconductor, we have a lot of OSAT, outsourced testing and assembly players in Malaysia. So if they are serving the back end industry, try to see whether back end is doing okay or not now. Try to look at the OSAT players currently. So they give you a very detail of what equipment will be used into what, kind of like what we do in studying university. Is a bit, I would say, very technical. I would go through it. Me myself, I go through it. Some I understand, some I don't. But at least I try to understand most of it. Then when I go into next company, I already have a baseline understanding on, oh, this and this I study from this company is for back-end semiconductor, right? And yeah, this is diving deeper into each of their processes. How do they do each processes? Yeah, and also this is the business presence. I think they're also diving deeper into the China region in 2 segments as well. Okay. So yeah, these are some of the examples that products that they sell, right? You can actually go and study their clients over here. You know who their sorry, not clients. You can study who are their suppliers and try to find out whether their supplier is having a good reputation in the market. Then you will roughly know whether they supply good products, tier 1 products, tier 2 products, and you get a gauge of what kind of clients they are able to serve, right? And in prospectus nowadays, they would share with you how many percent of revenue is contributed by their major client. but a lot of times their names are hidden. So how do you try to find out their clients? Okay, this is something uh this is something may or may not work because it could be the past, it might not define as they are still supplying to them. Is to look into the award part, right? So if you look at they are okay, later I come back to this page, 20 plus. Okay. Sorry, let me go faster a bit. Okay, if you look over here, you can see most of their customer name is hidden one. That means that you couldn't access who are their clients because of privacy issue. You cannot access who are their clients over here. But if you look back 24 just now. Wait. Okay. Where were we? Okay, it's around here. Okay, sorry, 23. If you look at their awards that they received previously, sometimes you can see who awarded them. So, for example, like Outstanding Supplier Award. So it's basically their client saying that you are an outstanding supplier to me. So I give you an award, right? Sometimes you look at the year, if it's too far away, there's a risk that this client may or may not be their client still. But still, you can get a rough taste of who are their clients, right? It usually doesn't mention is their in their customer profile, right? So and also capacity. If you are looking into a company with manufacturing capacity, a lot of times it would be, how do I put it? If you're looking into this part, they would mention, let's say my factory, I can produce 100,000 nasi lemak per day. I'm a central kitchen. So now I'm utilizing at 70% or 80%. They will tell you. So if you look in their prospectus, their company is performing very well, but their utilization is at full, let's say 95% or 90%. So you need to see whether their utilization of proceeds, are they expanding? If your capacity is so full, you're not expanding, so what are you doing with the money? So it's funny, right? And if your capacity is low, let's say 30-40%, and your performance is okay, but you're still expanding further. So what does that tell you? You are not utilizing your current facility, but you want to open a new facility. Then I need to find out why. Why exactly, right? So in section 7, they will tell you this. And yeah, these are the deeper parts, very detailed of the company background and whatnot, right? Major supplier percentage, major customer percentage, like over here. Over here, you can see major supplier percentage take up to 77% of their top, 85 in their latest year of their top 5 supplier. Sometimes they give you the name, most of the time, no. Most of the time, no. You have to find out yourself. Okay? And these are the things that I mentioned just now. When you are not manufacturing, you are supplying. What kind of agreement do you have? How tight, legally speaking, are you with your supplier? So they will have the distribution agreement over here. They will write it out. Okay? So these are the things that you need to understand. This is all in the business model part still. And you can also link to the utilization of proceeds, right? Then next is the IMR, Independent Market Researcher Report. This is very important, as I have highlighted multiple times. Why? Because number one, it explains how the business is and also the industry historical growth rate, right? What's the CAGR, compounded annual growth rate historically? Over here, it tells you CAGR, but normally it's a positive trend, normally. And also they tell you the customer industry, the industry they serve. E&E industry, semiconductor industry, are they growing or whatnot? And what are the government initiative and prospects, basically? And most importantly, they will also provide you with the competitor names. So you can actually study their competitor as well. And valuation, again, try to compare with their peers. So let's say if their peers is trading at 20, company is listing at 20, reasonable. But if their peer is 10, they're listing at 15 or 20, then it's a huge question mark. Why do you deserve such a higher premium as compared to your peers. Okay, this is the section 4 part. Sorry, section 8 part, the IMA. And okay, yeah, this is the IMA part, and section 12, section 12 is the in-depth financial performance of that company. And one thing is the cash flow is also very, very important. I save it for the last to talk about it because we're going to look into over here. Operating cash flow, is it positive? Now, based on my best knowledge, I think Shane can correct me if I'm wrong. For company that are listing in ACE, there are no requirement to have a consecutive 4 years positive cash flow from operating activities. But for company in the main market, unless your business nature is somewhat different, so let's say you are in a lending business. Lending business, of course, my cash flow is always outward because I'm constantly lending to grow. But if you do not have a consecutive operating cash flow that is positive, then number one, financially, it doesn't look good for you. That means that you're doing business, but you're not generating cash. So it's like a human. I'm growing bigger, but the insides of me, I have no blood flowing one, right? I'm flowing out blood. So it's definitely not a good sign in terms of cash flow. So operating cash flow, remember to look into it, right? And principal activities, and over the deeper part, they will talk about analysis. They will analyze deeper comparison of revenue each year. So you can understand what happened, that your revenue spike or your revenue drop or your profit drop, what happened over here. Tax rate, profit margin, whatever financially related, you can find in section 12. Okay. So I think that's pretty much it. I think let's move into the Q&A session to answer whatever questions you guys have, except or mentioning of any particular securities.
All right, thank you so much, Max Tan, for doing this IPO session with us. So many of us here would have known what exactly is the initial public offering, how to apply, and how do you dissect prospectus. So if any question to ask our speaker today, please write your question in the Q&A box, and Max will do his best to answer your question.
Yeah, a lot of interesting question coming in.
All right. So the first question I see on my screen is by Othman Azizan. So how do we determine the target price for IPO during the listing day?
I can't define the target price, but analysts, they give a certain range of target price. They have their IPO note that they talks about the prospects of the company. If you're too busy or you're too lazy to read the prospectus, just go for the research report, right? And they will usually give a target price. But target price is something very subjective. If the market is good, they might enjoy another 30-40% premium. If the market is not good, then we, not doing so well. And it's very subjective. So how do you define? I think you have to have an understanding. Usually, you understand the basic valuation of the company, and then you try to look into the analyst report. Is there very significant growth? If yes, then probably you can use forward PE to price the new IPO. But if there is not a lot of information around, then look into their industry average and give a premium, certain level of premium. It depends on the market condition. If it's good, you want to give 50% premium, also can. So for example, like peer is 20, but you give them 30 in terms of PE because the market condition is so good. A lot of interest could flock on the first day, also can. So yeah, there's a couple of ways that you can jump into the valuation part of the company. Yeah, if you specifically target price, you want something to refer to, we have a lot of licensed analysts to give you a target price.
Right. So the next question is by Yok Long. So Max, will you participate in a day one IPO trading when they just debut on the stock market? If yes, how do you manage day one non-performing risk?
Usually I don't. Because a lot of euphoria or a lot of excitement into the first day. Again, capital market, I think we did a session with Shane last time. Capital market is a place that full of emotion. The more exciting or the more excited the investors are, the higher the valuation of companies. It's always been the case. The more depressed or the more sad the investors are, the cheaper the valuation. So first day, a lot of people are excited about this company, right? So a lot of excitement and a lot of marketing has been done for this company on whatever platform it is. So definitely a lot of excitement. So usually premium on the opening has already been priced in, usually. So if I were to trade, there's a risk to me. Unless in some case I like the company a lot, right? But I cannot ballot it. Then the opening is lower than what we expected. For example, this company, maybe because of the size is larger, initially I expect to go 30% premium based on their peer valuation, but only go by 10. Then in this case, yes, probably I will consider. But I'm not asking you to, or if the company IPO didn't go up a lot means that I buy. No, it depends on how much you understand on the company. And if I participate, I only participate in those that the excitement is not so much, or so sway their first day in IPO, the market is really bad. Then I will try to participate in that IPO.
Thanks, Max. So will you prioritize IPO companies' latest quarter result as compared to past year annual result? So this is the next question by Yok Long.
Okay, I will look at next 2 or 3 quarters is very critical. Before their listing, usually they will announce 1 quarter, which usually is good if you get what I mean. And the next quarter is it depends whether it will include the IPO expenses or not. If it's a smaller company, you imagine one company they earn 6-7 million in a year. So this quarter they have a 3 million IPO expenses. Definitely they are gonna lose money, but it depends on how much they lose. If I take out the IPO expenses, are they profitable, right? And then the subsequent quarter, I will look into that. That is more important to me than how they perform to the previous annual result.
Thanks, Max. So the next question is by Izzat Aziz. How far can we trust a prospectus? Can a prospectus be overclaimly published?
I think I would like to believe that the regulators had done their due diligence process throughoutly, but I would say prospectus, yes, the information is real, but the problem is whether they can materialize some of the things that they mentioned. It's prospectus, if you look in the first pages, it's always mentioned already. This prospectus contains forward-looking statement. That means that when they are going for IPO, of course, most of the time they're expanding. And when they're expanding, whether they can successfully expand or they couldn't expand. When it couldn't expand, and I mentioned just now, when you buy equipment, you buy land bank, you buy a factory, there are depreciation. When the depreciation come in or additional operating expenses come in, it will reduce your profit. So in turn, you will feel like, hey, the company is not performing like you say you are growing at 30% after this factory is done, but you are actually dropping in terms of profit. So you have to understand every business, they have a gestation period. Sometimes it takes time to pick up. But if over a period of 6 months or 9 months, you observe already still doesn't perform, then obviously they didn't materialize what they promised. So I would say this is why we need to look into prospectus and understand their business to see whether it makes sense or not. I would say 80% study prospectus, 20% experience, and sometimes gut feeling also.
All right. So what does it mean if the company IPO is oversubscribed, for instance, by 150 times? Does that mean that it's a good company? So there's a question by Mahalingam.
Thank you very much on this question. I think I will answer this question in conjunction with another question. How do we increase our success rate? Let me share my screen. Okay, not really increase your success rate per se, nothing something so magical. Okay, let me answer your question first. What does it mean by oversubscription by X number of percent, X number of times? So imagine a company, let's say their market cap is 100 million. right? 100 million. As we mentioned just now, normally the public portion plus Bumi Putra portion will be equivalent to 5% of the public subscription portion, which means 5 million because 5% of 100 million market cap, right? So when the market put in 10 million into this IPO, it becomes 2 times oversubscribed. When they put in 50 million, it becomes 10 times. When I put in 500 million, it becomes 100 times. Based on my observation, our recent IPO, the money inflow is somewhere around 400 something to 500. Of course, they are lower, they are higher, but on average, if normal kind of company is around there. So you look at the market cap of the company, the smaller the market cap, the higher the oversubscription rate. It's because their share or their value is lower. So let's say like a company like Nana Smith Man. Hey, Nana Smith Man only I think 4 times oversubscribe only. Leh. Is it not so good? No. Is you imagine the sheer size of Nana Smith Man. How much is their market cap again? I think 13, if I'm not mistaken, right? The 5% of 13. So you just imagine how big this IPO is. The 5% of a 13B company. I couldn't remember the market cap full amount, but you get what I mean. But let's say 1B, let's not talk about 13B. 1B compared to 100 million. The difference in 10 times, even though 500 million capital flocked into this IPO subscription, it's still only 10 times as compared to the 100 times because the market cap is smaller. So there is no really definitive reasoning to the oversubscription rate, right? And I saw a question, how to increase success rate? This is something I also want, but magically couldn't be done. But the correct way of allocating your capital might get you lower capital, but might get you a better chance. Sorry, let me drink a bit of water. Okay, if you look at the screen over here, you can see that there's different range of shares, right? 100 to 900, 1,000 to 1,009. So what does this mean? A lot of people might not know this. Let's say 11,000, for example. If, okay, 10,000. If this company, the share price is 1 ringgit, you put in 10,000 ringgit. You subscribe for 10,000 shares, which means 10,000 ringgit. You fall under this range, okay? Your success rate is 5.02%. It varies from IPO to IPO, but this is the rough rate. This is from Solar District Cooling, just as an example for you guys. Okay, your success rate is 5.02, and actually it doesn't matter you put in 6,000 or you put in 10,000 into subscribing the IPO. It doesn't matter. You still get 5,000 shares at the end of the day at a success rate of 5.02. So if some people might catch on already. So let's say if I want to move a tier higher, I don't have to put in so much money. Is that correct? Yes. For example, if I'm already putting 180,000 shares to subscribe to the IPO, might as well I move to the other tier, right? 200,000 shares. I get a 0.3% increase in success rate, and I get additional 5,000 share increase if I get the balloting, right? So when you're trying to subscribe into an IPO, this is the trick I use. Whatever number that I want to subscribe, let's say I want to subscribe 20,000 shares, I will go 21,000. It might get me to the next tier. You wouldn't know until the results are out. But when it's 10,000, right? 10,000, try to add another 1,000. For example, here, 11,000. Just nice, move to another tier. Success rate is almost 1% higher, and you get 2,000 additional shares. Not a lot of increase in, the money that you fork out actually. Just increase by a little bit. This could be a drastic change in terms of your IPO subscription and your performance. But I've done the calculation. If you are so lucky to get the IPO, actually your average rate of return is annualized compared to the money that you put in. Is somewhere around 5-6% on monthly basis. Okay, if you get the IPO and on a normalized success rate. Okay, so this is how you quote unquote increase your success rate. Hopefully, this is helpful for you.
Thanks, Max, for sharing the tip. So the next question by Othman Aziza is, does oversubscription influence the opening price when they debut?
Yep, it does. It would give an impression of that the company is highly sought after, and the price mechanism in all capital market is always demand and supply. With the anticipation of a higher demand of the shares, there will be traders that are interested to trade on the day because they think that, oh, this company is likely that a lot of people are interested in this IPO. Then they would also participate in it, creating higher demand for it. So yes, it does impact.
All right. The next question is by SS. So in your opinion, Max, which principal advisors is considered tier 1, tier 2? Is there any advisor that in general less favored by the industry?
I don't think I can answer you that. But you can look. Okay, let's not talk about tier one, tier two because there are a lot of ways to define whether a sponsor or principal advisor is tier one or tier two. Maybe by size, maybe by the numbers of IPO they have done, maybe by the quality of their IPO, maybe by the success rate of their IPO. A lot of ways to quantify it. So I don't want to put any. I don't want to point fingers, but based on your question, if you really want to do an analysis, right? Just let me share my screen. Okay, just go to Busa website and do a bit of data mining and check the performance of that IPO on first day and afterwards, and who are the advisor or who are the underwriter. Then you will get the answer from there. Yeah.
Thanks, Max. So the next question is a huge number of shares offered a red flag?
Okay, there is, I think, two parts to this question. Higher number of shares, it depends from company to company. Sometimes a higher number of shares is because their share base is huge. In that case, you still need to look at their, what do we call? It depends on the percentage, right? How many percent is being offered and how many percent is issuance of new share? Basically, you can imagine this as an investor to that company, right? Very simple answer. You want the money go to the shareholders, or you want the money to go into the company. For the money to go into the company, it means that issuance of new share, like we mentioned at the first few slides. But offer for sale, it means that the money go to the directors or the sellers, or the sellers are promoters. Yeah, it goes to the promoters. So when it goes to the promoters, what to do with the company? Effectively nothing. So it's not exactly a red flag, but on a comparative basis, I would prefer them to put in, myself to put in my money into the company.
All right. So let's do one last question by Kok Chin. So is there any way for us to assess the integrity of the directors or company going for IPO from the prospectus?
Oh yes, but I think this one is a bit okay. If you want a free way, if you want a budget way, just copy their name, go to Google, and you will see their name. And also, they in the prospectus section 5, they will disclose each of the promoter and also their directors, their profile. So from their profile, let's say, one individual in Malaysia, according to Malaysia law, you can hold 5 director seats. If one of the seats that the director is sitting is in some funny companies, so they're associated in some way, I don't know, but that's one of the way. In prospectus section 5, you can assess who are they associated with. Number 2 is Google their name. Number 3 is, again, in section 5, it also disclose what company they have apart from this Berhad company. If you have the capacity, if you have the resources, you can do a CTOS check on the company that they own, see whether any got blacklisted, or you can go Experian or whatnot. This is more extensive kind of I think this is a bit forensic already lah. If you really want to go to that deep of a rabbit hole.
All right, so thanks, Max, for sharing with us, the tips on how do we assess the integrity of the shareholders or directors. All right. So thank you everybody for tuning into this session. So you just heard from Max, who is the founder of 12 Invest. So thank you so much, Max, for your time.
Thank you, everyone, and thank you, Shane.